Please understand the word is value. It is neither cost nor price, which means value of a share is not equal to its ongoing market price. That's the price. That's not the value. That's why we use the word intrinsic value, IV. And if you write intrinsic value IV0, that means this is the value assigned by you, whoever is calculating. Now, intrinsic value according to me need not be same according to you, because we assign the value based on our perspective about that investment. Now, if there is a site in Jainagar and if the seller is quoting 2 crore rupee, it is the price. And you go there, you think it's not worth 2 crore, you may not buy. 2 days later, someone comes and same price is quoted. He thinks it's very good price, he may buy. That means you and that other person both in your mind have already assigned a value for that site. If the price is less than the value assigned by you, you will purchase it. If the price is too high compared to the value assigned by you, then you think it is overpriced or hyped or costly, depending upon how we want to say. We say, no, this is too much, I'm not buying. That means everyone comes there with a value already attached to it. So if I'm buying a share at 730 rupee, according to me, it is worth more than that. Value according to me is maybe 745. Someone is selling at 730, therefore it's a good time to buy. If it is worth 745, why is someone selling at 730? According to that person, it is worth below 730. He thinks 730 itself is a fantastic price. Maybe he has done valuation. He thinks it is worth only 700. Therefore, 730 is the market price and that is not the correct value of the share. And there is nothing called correct value because it changes from time to time also, person to person also. Today I may buy it at 730. 2 years later at 730 itself I may say it is overpriced because I will re-estimate all my cash flows and all my expectations from that particular stock when time changes. Same site in Jainagar 5 years ago was 1.5 crore. Today it has come to 2 CR. That means value changes from time to time. Value changes from person to person. You yourself, an investment which you may not do today, 5 years later you think it was good rate, I did not buy. That means value will change even if the person is same because of the change in the time. Because as time changes, factors will change. 20 years ago, some areas in Bangalore, people used to get scared to go. Such areas. Somebody bought a site there and now city has gone till there. Now also people are scared because there is so much of traffic. Either way, but because of so much of traffic and people have gone there and have settled there, the real estate in that area has gone up. Suddenly, why land prices go up? Because people assign more value to that land because of the other factor. Someone says a new airport is coming in this area, automatically land prices will go up because someone is assigning more value to the same property, which was not there before the announcement of new airport. Someone says a big hospital is coming, a railway station is coming, metro will get extended up till this day, this point, then suddenly the prices will shoot up because people start valuing the same asset more. Therefore, at any point of time, if anyone has purchased a site, they will tell you on the day of buying, you will always feel it is costly. 10 years later, when you look back and say that I did a good thing, had I not purchased it that day, today I would end up paying whatever 2 times, 3 times for the same site. Therefore, value is also impacted by a lot of external factors. One, the valuer has his own perspectives. Second, there is influence from the external factors, right? Why I am saying this land as an example is in Bangalore from last 1 month. If you are following the news, a new topic has come up. Bangalore will have a second airport. You know this? And they have given 5, they've shortlisted 5 locations and 5 are in 5 directions of Bangalore. Okay. One, first they started somewhere near Hosur, if I'm correct. And then there was some problem. Tamil Nadu government said we will construct one in Hosur because Hosur is part of Tamil Nadu. And if you have another airport within 40-50 kilometers, this one which is near to Hosur inside Karnataka boundary may not give you good economic viability because you should have enough flights coming. If there is another airport within 50-60 kilometers, it won't make sense to have one more. and then said, okay, we'll go to the other side, and then someone said we'll do it in Tumkur Road, the entire other side, those who do not know, that end of green line. Okay. And then they said, no, no, this Biddi side towards Mysore, we already have a expressway now. It becomes very easy for people to go to the airport, because in Bangalore that is another problem. Not airport, going to the airport is another problem. So that will be very convenient. Then they said, no, in Kanakpura Road, the other side of green line. Now when these things happen, automatically, if anyone has inquired a particular layout, particular site 3 months ago and go today, you will see 10% appreciation, at least notional appreciation in all these areas. Now out of this, only one place will get that airport, and no one knows. Politicians will know, but then they will first uh, leave this rumor and sell all their properties nearby this, and then it's like short selling. You sell at high price, and then once announcement is made, the other four places appreciation will slow down. These guys will again buy. Anyway, we are not politicians, we don't have access to additional data. They have the access. But understand why real estate site prices go up whenever this news comes. People believe, okay, if an airport comes, then commutation will increase. More people will come and go. Automatically, more shops will come, more bus stops will come, railway station will come, metro may come up till this. And if I stay somewhere nearby, automatically demand for that particular site, and site can't be additionally created. So there is another advantage in site. So prices will shoot up. Even if there is no airport, if you buy a site in Bangalore, it will appreciate only, as long as there is no legal paper problems. A site has never depreciated. Any agriculture land or even a barren land, no agriculture done, no residential layout done, just a land will anyway appreciate. Why appreciates? Because people assign a value to a particular asset. Do you know what is the rate in Jainagar today per square feet? Per square feet is that much you can stand on. That's all is per square feet, one by one. Roughly 35,000 rupee. 35,000 rupee, where we are sitting right now. This site, if you want to buy, 35 to 40,000 rupee. That too, commercial is slightly higher, residential is lesser. 35,000 is a residential number. So Jainagar, where we are sitting, is actually a mix of commercial and residential. Commercial is always costly because you can earn rental incomes at a much higher rate when you construct. Residential rentals are much lesser than commercial rents. So if you're talking about 1,000 square feet site, it is easily around 3 to 3.5 crore. Today 1,200 is around 4 crore rupee. Now why people assign so much? You go away from Bangalore city, say about 8-10 kilometers, just near toll. That's the easy way to understand. Then per square feet maybe even 3,000 rupees. Yeah, because people are not assigning so much of value. And again, an airport news is enough for that 3,000 to become 3,500 within a couple of months. Therefore, 2-3 important things here. Number one, value is not one correct perfect number. Value changes from, number one, person to person, time to time. Number three, value is influenced by two factors. One, internal factor, that is your estimation. If I buy this share, how much dividend I can earn. It is your calculation. What is the expected rate of return? My expected rate of return may not be equal to her expected rate of return. That means these are internal factors that will affect valuation. Fourth one, external factors will also influence. A fake news, a rumor is sufficient to bring down a share price. Even if everything else is good in the company, a fake news is enough for it to come down. So 4 factors to be understood before you make any valuation. And then value is not equal to price. Value is written as IV. And if you are doing valuation today, it is called IV0. And IV0 is compared with P0 or MPS as on today. Most of the formulas they write P0 is equal to something. That is P0 according to you. You cannot find out what should be the market price. That I will get to know when I log in at 9:15. Correct? That means whatever valuation I am doing, though formulas are P0, I'm actually calculating IV0, intrinsic value as on today. Done. Write down. Heading, fundamentals of valuation. Fundamentals of valuation. Value of in inverted comma anything, value of in inverted comma anything is present value of future cash inflow. Present value of future cash inflow. Point number 2. Value here refers to intrinsic value. Value here refers to intrinsic value. Full stop. In bracket you write IV. If valuation is done today, if valuation is done today, it is written as IV0, like you write P0, IV, small 0, full stop. Value is influenced by expected amount, comma, expected rate of return, by an investor. Expected amount and expected rate of return by an investor. Last line, value changes from time to time and person to person. Value changes from time to time and person to person. Yes, listen. In the last part of this chapter, I've given you a bullet there, list of things to be covered. In that you have theory. In that there is an important theory. What are the responsibilities of the valuer? So if you are doing the valuation of a share and preparing a valuation report, one of the important responsibilities is that you mention in the report that this report is prepared on this day and all that is applicable is as on today. You can't read this report and where the value of a share is 173 rupee, you read it after 8 months and then buy the share based on 173. I am not responsible. This is correct only on valuation date. So if you are making an immediate deal, 2 days later, 3 days later, based on this, you use this report. I cannot use 2023 valuation report and say today the share is worth so much, because in between, as you have written just now, amount of return may vary, expected rate of return may also vary. Therefore, valuation of anything that you do is correct on that day only. As I told you, before airport announcement, after airport announcement, value may change. So I cannot take the site price 1 year ago and do any calculation today. Between that day and today, lot of things have changed. Following? By the way, this question that I am discussing, how long can I use a particular valuation report? This was there in a CA WhatsApp group a month back. One of the practicing CAs have put this question. He has put this question saying one of my client has got the valuation report done 1.5 years ago. Can I use it today? That group is for discussion and connect. Understand this, valuation is applicable on that day or for immediate usage. You cannot take valuation report of 2.5 years old and say today should be the same price. In between 2 years dividend is given. In between share prices would have gone up. In between company would have got demerged also. They would have acquired some other companies. Many things would have changed. Therefore, any valuation you do is for immediate use only. Understanding? Now, basics. When I'm buying an asset and if I'm expecting some rate of return, some amount of return, there can be multiple varieties. One, I am buying a share today. I'm expecting equal amount to come to me forever. That is called a series of equal annual cash flow. D1, dividend at the end of year 1, D2, D3, D4, how many years? forever. Why forever? Because I'm talking about a share. Now it can be for 3 years, it can be 5 years. We're starting with infinite series of cash flow. Second possibility, I will earn dividend, but dividend will grow. First year 8 rupee, next year I'm expecting. You have written two things. Remember, value depends on two things. How much is the amount and how much is the rate. I am expecting that dividend will start from 8, but it won't stay 8 forever. It will grow at 5%, 5%, 5% forever. This is second possibility, that you earn cash flow and it will grow forever. Third, it may grow but may not grow at same rate. 8 rupee, next 3 years you are expecting it to grow by 2%. After that 5% for 5 more years. After that forever 25%. That means growth of dividend is also not same. Sir, it may also happen that there is no trend at all. 8 rupees, 6 rupees, 11 rupees, 3 rupees. Correct, that's also possible. But how long can you estimate like this? I am buying TCS share today. I am expecting some dividend, 8 rupee next year. D1, dividend at the end of year 1. That 8, what is the expectation? D2. Either 8 remains 8 or 8 will grow at same rate, 5%, 5% forever, or you're expecting next 2-3 years there will be some slow growth. After that growth will increase. But you can't easily predict 8 will become 6, 6 will become 11, 11 will become 7.5. Therefore, this variety problems are very less, because in practical world also this kind of estimation is difficult. Therefore, three types of problems, and in real world also three types of scenarios you will see. One, constant income forever. Second, income which is growing at same rate forever, 5% growth up to infinity. Why infinity? Because we're talking about equity shares. Third, there is growth, but the growth rate is not constant. May grow at 5% for few years and then may grow at 8%. Now, when I'm buying a share of a newly start company, then I'm expecting what? No dividend for first 3 years, then some dividend for next 3 years, and then it will grow at some rate, and then it will grow at a much higher rate forever. That means I have 4 stages. First 3 years, zero cash flow. Next 3 years, 3 rupee, 3 rupee, 3 rupee. Next 4 years, it will grow at 5%, 5%, 5, 5, and then it will grow at 25%. From there forever. Forever, because we are talking about an infinite cash flow series. When we are talking about equity share valuation, it's an infinite series. When you're talking about business, it is infinite series, because equity share is expected to be forever, because business has a perpetual life. But if you are talking about a bond, then it may not be perpetual all the time. They may give a data like this: you're buying a bond today, keeping it for 3 years and selling it. That means, now read the first line you have written: present value of future cash inflow. Future cash inflow is only for 3 years. Why present value? Because you're buying today. You want to convert all future cash inflows also to today's value. This is exactly what you do even in NPV. Year 0 outflow, year 1, 2, 3, 4 inflow. You can't compare. You bring it down to today. Correct? That means you are buying a share today, planning to hold it for 3 years. Now tell me, if question is like this: Mr. A is buying TCS share for 1000 rupee today. That's the market price. He is expecting 3 years dividend like this: 80 rupee, 90 rupee, 100 rupee. At the end of third year, he is planning to sell it at 1800 rupee. Now calculation is very easy. Year 1 into discounting factor first year, second year, third year. And third year you will have some dividend plus sale value. That total is the intrinsic value according to you. Now see here, to get intrinsic value you need two things. One, you have to do estimation of cash flows. You did 80 rupee dividend, 90 rupee dividend, 100 rupee dividend. Second, you also have to put the rate, the discount rate. If you are taking 10%, that is the rate according to you, and that's the point that you have written. Value of anything depends on these two things. One, expected amount of return, which is always cash returns, cash flow, and second, the correct discount rate. Now correct discount rate is the expected rate of investor. If I am an equity holder, then my expected rate is cost of equity, KE. That depends on multiple formulas, and the most commonly used formula is CAPM formula, risk-free rate plus beta into RM minus RM. That gives me the expected rate of return. So all the future cash flows, I will discount it at my expected rate of return. That gives me the correct intrinsic value. That is my intrinsic value, because I made dividend estimation, I took that rate. That may change. He may expect lesser dividend, his discounting rate may be different. That's why somebody is buying and someone is selling. Otherwise, if the share is so good, Why is someone selling at 735 and why is someone buying at 735? That means someone thinks it is overvalued and someone is thinking it is undervalued. According to them, it is overvalued. According to them, it is undervalued. So what you see in stock market is not value of the share, it is the price of the share. That's why you keep hearing this stock is overvalued, this stock is undervalued. That overvalued, undervalued is from the perspective of the one who is saying. Even when he's saying overvalued, someone is buying, by the way. At that right minute, someone is buying because he thinks it is undervalued. It's extremely important that you understand these basics properly. Value is not equal to price. But in class, when we work out some sums, formula may start with P0 is equal to something. That means we are trying to find out price, but that may not be the price in the market. Actually, we are trying to find out intrinsic value, IV0. You know what is the biggest criticism on this cryptocurrency? This itself. What is the first line? Value of anything is present value of future cash inflow. Then tell me how to do valuation of a cryptocurrency. Valuation of Bitcoin is equal to what? Present value of future cash inflow. Correct? What are the future cash inflows if I have a cryptocurrency? Am I getting bonus shares? Am I getting right issue? Am I getting dividend every year? Is there EPS? No. That means I'm not sure of future cash inflows. Second, at what rate should I discount it? The risk is very high. That means accordingly beta will also be extremely high. Why risk is high? Because that asset is not trusted by everybody. Why it is not trusted by everybody? Because at least in Indian context, to trust any asset, you should be able to see it, touch it, feel it, wear it, any of this. Now tell me, if I am holding one share of Reliance, I can go to Reliance factory, touch one furniture and say 1/1000 of this is mine. Because there are 1000 shareholders, I am one among them. This furniture also 1/1000 is mine. That inventory 1/1000 is mine. That cash 1/1000 is mine because I am one out of 1000 shareholders. That means people can understand that this is my asset. Land I can see, touch, feel, sleep there. It is an asset. Gold I can wear. In crypto, the biggest criticism is I have unlimited risk because I do not know where is that asset, who is holding it, can I touch, can I feel, can I exchange it for something else, can I buy a cup of coffee using it. Unless it becomes negotiable instrument, people will consider it as high risky investment. So two problems in valuation of any cryptocurrency. One, how do I estimate future cash inflow? I don't know what I'm going to get in future. Second, what should be the rate of discounting? That rate of discounting comes from RF plus beta into RM minus RF. RF I can get, market rate I can get. For ascertaining beta, beta is a measurement of risk. How do I measure the risk involved in cryptocurrency? Land I can, suppose if I buy a site today and keep it for 5 years, I sell it after 5 years. That means year 1, 2, 3, 4, no cash inflow. Year 5, cash inflow is sale value of the site. Multiply by discounting factor for year 5. That will tell you present value of future cash inflow. Second example, I am planning to buy a commercial property, rent it for 5 years and then sell. Now how to do the valuation of that commercial property? Present value of future cash inflow. And what are the future cash inflows? Annual rental income. That may have some growth. Suppose 5 lakh, 5 lakh 50,000, 6 lakh, 7 lakh, 8 lakh. Future cash inflow. Plus fifth year, I'm planning to sell that property for 1 crore. Now you can prepare a table here 1, 2, 3, 4, 5 future cash inflows, and then you calculate the applicable discounting rate. Then you know what should be the value of that commercial property today. Therefore, any asset, whether it is giving you regular cash flow or not, whether it is finite series or infinite series. When I say commercial property is for 5 years, then it is finite series. You don't call it as perpetual investment. But when I say I'll buy a site and keep it with me forever, then you're talking about infinite series. Within finite and infinite, there may be regular income, there may not be regular income. When I buy site, there is no regular income. But if I buy a commercial property, there can be regular income. Only way you can make regular income from site is if you give it to some parking guy and then appoint him and collect some parking income. No additional investment. You only have to do net cash inflow. Parking revenue collected minus salary paid to that boy. That difference is your annual cash inflow. Some asset you may have, some asset you may not have. I told you an example. Startup. You buy a share today, wait for 3 years, no dividend. That means D1, D2, D3 cash flows are zero. D4, D5, D6 you are expecting something. After that you are expecting a growth, and from there it is forever. That means 3 stages. No dividend, dividend without growth, dividend with permanent growth or perpetual growth. So any asset other than personal asset, don't apply this to a car if you're planning to buy for this festival, because car is not an asset that we are covering in this topic, because car is a personal asset. You cannot have present value of future cash inflow if you're buying car and using it for your purpose. But if you're buying a car with a plan to rent it out for a cab company, then you put an Excel sheet, do present value of future cash inflow. So whatever I am discussing is not applicable for personal assets. For ring, you can't calculate present value of future cash inflow because it's a personal asset. Clear? Start. In case there are, start writing, equal annual cash flow up to infinity. Equal annual cash flow up to infinity. Value of such cash flow stream. Value of such cash flow stream or value of such investment would be expected annual cash flow. Expected annual cash flow divided by applicable rate. Intentionally I have not written dividend because I am discussing basics of valuation. This can be commercial property, this can be site, this can be share. Whatever cash inflow you are expecting, that's the numerator divided by applicable rate. Now you modify this and tell me, if I am doing valuation of an equity share, what will be the numerator? Annual cash flow, dividend. Therefore numerator is D divided by, if I am an equity shareholder, what is the applicable rate? Cost of equity, KE. Correct? If I'm a preference shareholder, numerator will be preference dividend divided by KP, because I'm a preference shareholder. For me, applicable rate will be KP. And if I'm a debenture holder, then interest I divided by KD, because I'm now a debenture holder. For me, applicable rate is cost of debt, KD. And how to calculate that KE, KP, KE is all the formulas that we have already discussed. Correct? Most commonly used for equity is capital asset pricing model, CAPM, where KE is equal to RF plus beta into RM minus RF. I said D. Is it D0 or D1 or D2 or D3? It is simply D, because read the heading, in case there are equal annual cash flow up to infinity. So why are you worried whether it is D1 or D7? It is same D, correct? If it is 7 rupee forever, why to even ask whether 7 now or 7 later? 7 is 7 only. To be divided by applicable rate, and that applicable rate for equity will be KE, cost of equity. Yes. Second, start writing. In case there is equal annual cash flow up to infinity, I think we have copied this already. Value of such cash flow is equal annual cash flow by applicable rate. Yes, this I want you to understand and then copy. Read this. Year 0. This is when you are buying, standing today. And what are you expecting? Dividend at the end of year 1, which should ideally be written as D1, D2, D3 up to infinity. But since that D is same, you don't have to write D1, D2, D3. You can simply write it as D. D divided by, what is the applicable rate? Say it is 10%, and if dividend is 8 rupee, it is 8 by 0.1. 8 by 0.1 will give you 80 rupee. 80 rupee should be the value of that share. I repeat, you are buying a share today expecting dividend to be 8 rupee. When? Forever. Every year 8 rupee. That is why it's called equal annual cash flow. For how many years? Infinity. That means the formula is D by KE. Annual cash flow divided by applicable rate. Not in inter. This was in foundation, if you can recall. Value of annuity series, value of perpetuity series. There was a formula A by I. A is annual fixed cash inflow divided by I. I is the applicable rate. Yes. It is an equal cash flow series up to infinity. Value of that series will be D by K. K, if it is share, then it is KE. If it is debenture, then it is KD. What if I am doing valuation of a business which is expected to earn same cash flow forever? then numerator will not be D. Business will not earn D. Business will earn EBIT. And denominator will not be KE. For a whole business, when you're doing, it is KO. To remember how to calculate KO, cost of overall capital, is nothing but WACC, weighted average cost of capital. Therefore, understand, if numerator is for equity, denominator should also be applicable equity rate. Many do this mistake. EBIT by KE. EBIT is for the whole business. KE is only for equity. If numerator is for the business, denominator should also be for the business. Therefore, now equity dividend by cost of equity, preference dividend by KP, debenture interest divided by KD. But if it is business, it is EBIT divided by KO, cost of overall capital. Yes, make a note. If dividend is 8 rupee, if dividend is 8 rupee forever and applicable rate is 10%, then value of such share is equal to 8 by 0.1, correct? That is equal to 80 rupees. Yes, listen to me. The sentence says infinity. Therefore, in an Excel sheet, I know infinity cannot be calculated. I'm taking the same example. Here, we are going to earn from year 1 and infinity. Therefore, I can take it as for any number of years. I'm going down for, say, 100 years. And this, when I copy, this series is for 100 years. And this can continue. As of now, I'm just keeping 100 years. And what is the cash flow that I'm expecting? 8 rupee. And this 8 is also not going to change because we are discussing equal annual cash flow. That means I will buy the share and earn 8 only. And what is the discounting rate? The applicable rate is 10%. That means I should be taking 1 divided by 1 plus R. At the end of year 1, it is 0.909. I'm not doing NPV table, so I directly started from year 1. But next year, 1 rupee will be further down. It will be 0.826. This you know how to do. And this is for unlimited series, and we have taken for 100 years. Anyway, that you know what is the meaning. And then when you do CF into DF, you're actually doing DCF, discounted cash flow. See, the first line you have written, value of anything is present value of future cash flow. So to get the present value, you have to multiply cash flow with applicable rate. And here it is 10%. And if this is done for 100 years, the numbers will come to something like this. And if I do the total, if someone can read here at the bottom, sum is 79.999, which is 80. For those who cannot read, sum here. This is 79.9. If I round it off to nearest 2 decimal points, this will come to 80. And that 80 can be also calculated if you simply do 8 by 0.1. And this is your formula, D by K. Able to follow? Now, infinity is not 100. Infinity is much beyond 100. Therefore, just to make sure that there is no such doubt left, I'm going up to 250 years. 2 more. Now, what happens? This 8 will continue anyway, and this discounting will continue, and this calculation will continue. And now you see what I have done. 8 rupee for 250 years. This was year column, cash flow, discounting, CF into DF. 250 years if you do, and then if you do summation of this, it is still the same 79.99 or 80. That means by adding extra year after a particular point, you will actually not get any value. Think of 8 rupee after 250 years. It's as good as getting nothing. Therefore, infinity, in theory, Here you can put another 250 years also. This will not go because you see this, we are only adding more and more zeros. Correct. Therefore, those who are expecting, sir, another 100 years, at least one paisa will get added. Once it becomes zero, whatever you multiply with, it's not going to make any impact. After few number, here itself you can see it has reached zero. After what, about 79, 80 years. After that, any addition you do, it is not going to make any impact. Now, instead of doing this circus for 250 years, we can simply say 8 rupee divided by 0.1. Value of an infinite cash flow is D by K. Clear? Coming back. But this is correct, whatever I discussed, if D remains same, if 8 remains 8. But if 8 becomes 8.2 and next year it becomes 8.5, then I cannot say it is infinite equal annual cash flow. It is infinite series with growth. Yes? Please copy this. D by K. Now I have this question I want you to explain. When I do D by K in, I think you have written 8 by 0.1, 80 rupee. This 80 rupee, is it value as on today or is it value at the end of year 1? I repeat my question. I am buying a share today. Expected dividend is 8 rupee. Applicable rate is 10%. You saw in Excel sheet also and using formula also. D by K will give you 80 rupee. My doubt is 80 rupees the value of the share as on today or is it the value of share after 1 year? Is this 80 rupee value of share today or value of share after 1 year? It is value of the share today. Today I have to buy this share, then only I will earn 8 rupee after 1 year. Tell me, if I buy the share after 1 year, will I get D1? No, I'll get D2. Hello, please understand. If I buy a share today, I will get dividend after 1 year. If I buy the share after 1 year, I'll get dividend 1 year after that. That means if you want to do value of the share after 1 year, then you should not take D1. You should start from D2 actually. Or answer this question. Can I buy share today and ask for dividend today? No. That means I have to invest today to get the rate of return after 1 year. Guys, compare this with bank FD also, it's the same thing. I have to put 100 rupee today to get 6% interest after 1 year. I can't put 100 in the morning and say give me 6%. Please understand. Many people do this mistake also. D1 by P0 is the formula because you have to pay P0 to get D1. People change this D0 by P1. Okay, what is D0 by P1? You will give me dividend today, I will buy your share after 1 year. Fantastic. That cannot happen. Can it be D1 by P1? Can the formula be D1 by P1? No. I can't buy the share after 1 year and expect you to give me dividend that day. I have to buy the share today and you will give me dividend after 1 year. If you are getting confused, just compare this with bank. If I deposit today, I get interest after 1 year. That means this investment decision should be taken today. That means any valuation that you do is on the day on which you are making that investment. Yes, right now. If you want to write both issue and answer, you write both. Or if you just want the answer, you can write only the answer. The question is D by K, the 80 rupee that you calculated, would be the value at what point of time? And the answer to that is it's the value 1 year earlier before the starting point of the series. What is the meaning? If series is starting 1 year from today, then the value is as on today. Understand what you are writing properly. 1 year earlier before the starting point of the series. The series means cash flow series. Cash flow series will start from year 1. That means value is as on today, year 0. Make a note. It means 80 rupee that we have calculated. 80 rupee that we have calculated is value as on today. Value as on today. Done. You have written already. In the present case, the series has started from end of year 1. That means value of the share is beginning of year 1. Simple. You always have to invest first to get the money later. Therefore, value is done first. Cash flow series will start later. Suppose infinite equal annual cash flow starts from the end of year 6. Listen to me first. You buy a share today. At the end of year 1, you get nothing. End of year 2, 3, 4, 5, nothing. And here they are saying you buy a share today, 5 years no cash inflow. 6th year, question says end of year 6, you are going to get 8 rupees. Now you tell me, if you use the same formula 8 by zero point 0.1, this 80 rupee will be value at what point of time? Today or end of 6th year or beginning of 6th year? It will be beginning of 6th year, or you can say end of 5th year. I repeat, understand the example properly. If you don't get these basics, next two topics will be very, very difficult. I buy a share today, year 0. What am I going to get? Year 1, 2, 3, 4, 5, nothing. That means cash flow for 5 years is 0. Year 6 end, I'm going to get some cash inflow. And as per the example we wrote, 8 rupee. Now, standing at the end of year 5, you will do the valuation 8 divided by zero point 0.1, because your valuation number is always 1 year before the starting point of the infinite cash flow series. Cash flow series will start from end of year 6. That means this will be the value at the beginning of year 6. Beginning of year 6 can be said as end of year 5. Guys, if you're getting dividend at the end of year 1 and value is 0, that means if you're getting dividend at the end of year 6, then value should be 5th year, correct? You only have to do minus 1. Following, copy this. Suppose infinite equal cash flow starts from the end of year 6. What would be the value of cash flow series? What would be the value of cash flow series? Value of cash flow series means value of that share. Cash flow series means dividend that you are going to receive. Tell me, in this case, D by K would be the value of cash flow series. D by K, because annual cash inflow is same. But that value will not be value as on today. This will give you value at the end of year 5. But tell me, will this be end of my answer? No. I have to make the investment today. I can't take this number because this number value is applicable at the end of 5th year. So how to bring this number to today? Multiply this with DF5, discounting factor for year 5. Able to follow? You first find out the value. If that value is already today, then you don't have to do any discounting. This answer that you're going to get is value after 5 years. Therefore, to bring it down to today, you have to multiply by discounting factor year 5. So whatever D by K you apply, you should multiply by discounting factor year 5. Therefore, value as on today. Today always means year 0. Value as on today will be what now? D by K into discounting factor at, in our example, 10%. And when is this valuation? 5th year. That means in the Excel sheet understanding, tell me what should I change in my table? When is my cash flow series starting? End of year 6. That means these numbers will become 0, correct? You will start getting money from here. All okay? That means when you do the valuation, you will get the value at the end of year 5. at the end of year 5, but I want to make that investment today from year 5. How to bring it to today? Multiply that by discounting factor year 5. So in calci, what should happen actually? D by K, 8 by 0.1, 80 rupee multiplied by fifth year factor. What's the fifth year factor? 0.620. Sorry, this should be the value of the share. Tell me, why is it less than the original number? Your original number was what? 80 rupee. But what's the number now? 49.5. Why is the value coming down? Because for 5 years I am not earning anything. If cash flows come down, value comes down. Imagine you are buying a share and earning from year 1 itself. You are ready to give more value to it, more price to it, because there is cash inflows. But I'm asking you to buy now and wait for 5 years, get nothing. You're not going to earn any income. How can you say it's a good investment if it's not giving you any return? Understanding? Now if you apply it here, year 1 2 3 4 5, you are earning nothing, and then infinite cash flow will begin from here. So if you follow this formula, I think here I've done the summation. Yes, if I just minus this, sorry, I already had this, is equal to sum from here till this is giving you 49.67. Able to follow? We can't do it in Excel sheet style. Therefore, the formula D by K will bring you down to fifth year multiplied by DF5. Why DF5? Why not DF6? That D by K 80 rupee is already value at the end of year 5. From there, you have to bring it down today. Understanding? Now, I want you to do one more thing. Continue. Suppose infinite equal annual cash flow. Keep writing. This is all classroom discussion. Suppose equal annual cash flow is starting from end of year 9. What would be the value of cash flow series? What would be the value of cash flow series? Understand and do. Answer. Tell me now. First, can we use D by K formula? Yes, because it is an equal annual cash flow up to infinity. So first do D by K. 8 rupee divided by 0.1. But this number, answer now. When are you starting the cash flow series? End of year 9. That means this will be value at the end of year 8. 1 year before. That means from there to bring it to today, you have to multiply by discounting factor 10%, 8 years. So D by K into discounting factor at 10%, 8th year. You are getting cash flow at the end of year 9. That means when you do valuation, it will be value at the end of year 8. You have already written. Valuation is always done 1 year before the starting point of the series. By the way, if you're not very comfortable with the term series, it's a APGP terminology, cash flow series. Correct? And when I buy an equity share, I'm expecting every year some income. It's a series of cash inflow. So what should be done now? 8 by 0.1 into discounting factor 10%, which year? 8th year. What's the number? 37 point. That's the value of the share as on today. Anything more than that, it is overpriced. Anything less than that, it is underpriced. Just for your comfort, tell me in the Excel sheet now, I have to change first 6th also 0, 7th also 0, 8th also 0. Correct? And then when I do the summation, the value of that comes to 37.3. Following? Comfortable? This is true if D is constant, but in reality, cash flows may not be constant. It may grow at same rate forever. it may grow at different rates forever. All of that we'll discuss after a break. All right, so that was dividend remaining constant, infinite series. It may start from first year, may start from eighth year. Any time the valuation that you do will give you the value 1 year before the starting of the infinite series. Next, this I think we already discussed. If it is year 6, value will be year 5. But if you want to get today's value, then you will have to bring it down from year 5 to year 0. For that, you multiply by df5. Yes. In your notebook, write this as examples. These problems are not printed in the book. This we have to learn before we start this sum. Example 1. What would be the present value of equal annual cash flow? What would be the present value of equal annual cash flow of 120 starting from end of year 1 if discount rate is 12%? Two things that will decide any valuation: expected cash inflow, applicable discount rate. 120 is estimated cash inflow, and this will be at the end of year 1. So when you do valuation, you will directly get the value as on today. Then you don't have to apply any further discounting because this number is already as on today. Example 2. Consider example 1. Consider example 1 and assume that equal annual cash flow starts from end of year 4. What would be the present value? Of cash flow stream. Now, if the cash flows are starting from end of year 4, your valuation will give you end of year 3 number, but you have to bring it to today. Correct? Formula is same, 120 by 12%, because it is equal annual cash flow forever. But then this number will not give you today's value. It will give you value 1 year before starting point of infinite series. That means the number is applicable on last day of year 3. So how to bring year 3 value to today? Multiply by discounting factor for 3 years. That is 120 by 0.12. And since this is value after 3 years, this will be then multiplied by 0.712. 712 has to be less than the first example, because in first example income started immediately from year 1. Here you have to wait for 3 years. Since the income is less, value will also be less. I told you, a commercial property will rent is high, value will also be high. If rent is less, then value will be less. Example 3. Listen, first understand the question. Find out the present value of following cash flow stream at a discount rate of 10%. End of year 1, 30 rupee. End of year 2, 40 rupee. End of year 3, 45 rupee. Thereafter, 50 rupee per annum forever. Think and answer. Can I apply D by K formula standing today? If I have to apply D by K standing today, then whatever is year 1 cash flow, that should remain same forever. That will happen, but not now. Tell me, you will start getting same cash inflow Not in year 1, not in year 2, not in year 3. That means this year 1, 2, 3 you have to do separately. Able to follow? Now visualize a table. Year 1, 30 rupee into DF1, first year discounting. Next 40 rupees, second year discounting. Third year, 45 rupee, third year discount. And then they say 50 rupee thereafter. That means starting from year 4. Able to follow? That means this D by K can be used, but cannot be used now. Can be used only once infinite cash flow begins. Able to follow? Now this is not growth, because for the growth the rate should be given. 30 became 40, 40 became 45, but after that it is not growing. That growth is a separate concept. The growth should be forever. Here it is not growth forever, and it is not even constant forever. That means formula won't help from beginning. You better do a small table for year 1, year 2, year 3. Year 4 onwards, you can do D by K formula. Formula is useful, but not directly applicable. Start. First write the question. Find the present value of cash flows with discount rate 10%. Basically asking you to find the value of that share, where you're expecting 30 rupee at the end of year 1, 40 rupee at the end of year 2, 45 at the end of year 3, and 50 thereafter. That means year 4, 5, 6, 7, 8 up to infinity, it is 50 rupee. Now answer to this. Tell me, you cannot use the formula directly because cash flows are not same from the beginning. Start. Year 1, 2 and 3 you write. Do not write one more 3. Year 1, year 2, year 3. Second, cash flows 30, 40, 45. Only this you take now. Don't worry about the forever part. But this money will come after 1 year. Value of anything is present value of future cash inflows. That means future cash inflow I should discount. At 10%. That means 0.909, 0.826, 0.751. Listen, no multiplication needed. Is this the end? Are we going to get money only for 3 years? No. We are going to get 50 rupee per annum forever. Now listen. I am adding one more line item, year 3. Why is it year 3? Year 1 30, year 2 40, and then 45. Now suppose I am standing at the end of year 3. Tell me from here, can I use D by K? I repeat, if I am standing at the end of year 3, from here, what can I see in future? 50, 50, 50, 50 forever. Understand? I am standing at the end of year 3. And in my future, what am I seeing? Forever, same cash flow. That means D by K can be used. Now tell me from when is the infinite constant figure is starting? End of year 4. That means value will come down to year 3. The D by K will give you value 1 year before the starting point of infinite series. Infinite series is starting from year 4. That means it will give you value at the end of year 3. Therefore, I am adding one more line, year 3. Start. This will be D by K, 50 divided by 0.1. Correct. This will give you 500. But this 500 is value at the end of year 3. Anyway, for year 3, we already have 0.751 as the DF. Next sum, if you want, you can merge this 45 plus 500. We had to understand that, so I went slow. And this, when you multiply, you will get resulting present value of future cash inflows. This comes to 469.6. I have a small doubt. Answer. Why I cannot use D by K in year 0, year 1, year 2? Because the infinite cash flow is not starting. It will start from year 4. That means standing at the end of year 3, I can see my future being a constant number. My future should be a constant number. That day you stand and use that formula. Understanding? Just to validate this, I'm just a second. Yes. Tell me here. What should happen now? How much is the dividend year 1, by the way? 30 rupee. Second year, 40. Third year, 45. After that, 50 forever. That means the infinite series is starting from year 4. Correct? And what is the discounting rate in the question now? 10 or 12? 10? No. 10%. That means this is 909,826 and so on. This is what you have: 27, 33, 33, and from here 50, and this will continue. Value is 469.8 exact. In the rounding off, you get around 469.7 or 8. Clear? Able to follow? Next. Sorry, I think the yes. Next heading: equal annual growth up to infinity. Equal annual growth up to infinity. This is second category. First category is no change in dividend. Now dividend will change, dividend will grow, and this is for infinite period. Now tell me, can I say D0, D1, D2, D3 is all same? No, D1 is greater than D0, D2 is greater than D1, D3 is greater than D2. That means D by K can't be used. The formula D by K can be used if D is constant forever. Yes. Start writing. In case annual cash flows are growing at constant rate up to infinity, value of such cash flow is equal to, next line you write separate formula, value is equal to first cash flow, very important, first cash flow divided by discount rate minus growth rate. Discount rate minus growth rate. Now you tell me for an equity share, next line, for equity share, comma, next line, value of the share today is equal to, you tell me what should be the formula. They said first cash flow, is it D1 or D2 or D3? D1. If you buy share, don't say D0. If you buy share today, you won't get today's dividend. You'll get dividend after 1 year if you buy share today. That means in formula style, D1 divided by K minus G, and K here is KE. D1 is KE minus G. This was the formula we discussed on day 0 also, by the way. D1 by KE minus G. By the way, D1 also, how do you get? D0 into 1 plus G, because dividend is growing now. Correct? But today you won't get that money. Therefore, I'm not starting with D0. But how to reach D1? D1 is D0 into 1 plus G. Make a note if you want. Class note. D1 is equal to D0 into 1 plus G. Now, how to identify in question whether they're talking about D0 or D1? Read properly. They say current dividend, present dividend. That means they're talking about D0. If they say expected dividend, dividend planned, future dividend, they're talking about D1. Correct? If they say present dividend 3 rupee, you can't take 3 in the numerator. Numerator is not D0, it is D1. Then they say it will grow at 10%. Then you can take 3 plus 10%, 3.3, because the formula is first cash inflow divided by applicable rate, which is KE minus G. Now the common doubt, shouldn't growth be added? Why are we doing minus G? Shouldn't it be plus G? See where you are doing minus. You're doing minus in the denominator, not numerator. Denominator is coming down. That is good for valuation. Think 100 by 10, 100 by 5, 100 by 10 is 10 rupee, 100 by 5 is 20 rupee. So if your denominator is coming down, it is actually increasing the value. If it is numerator, you should add G. It is plus G. If you are in denominator, it is not minus. Minus in the denominator is good only. Understand my sentence. Minus in the denominator is good. 100 by 10 is 10 rupee, whereas 100 by 5 is 20 rupee. Now 10 will come down to 5 only if you minus something. Denominator should be a smaller number for the value to go up. Following, actually we are doing plus G, but because it is in the denominator, it is written as minus G. Able to follow? In case first cash flow is starting at the end of year 1, we call it D1. The above stated formula will give you value 1 year before. That means it is IV0. Formula is IV0 is equal to intrinsic value 0 is equal to D1 by KE minus G. Clear? Start. This you see whether you want to write. If you think it is necessary, you can copy. How will the table be now? You will get D1. Next, D2 will be D1 plus growth. D3 will be D2 plus growth. That growth can be written as D1 into 1 plus G, D2 into 1 plus G, or D1 into 1 plus G to the power 2. Don't get confused. D1 into 1 plus G is D2. Then if I want D3, I can write it in two styles. D2, on that you apply growth, or on D1 you apply growth twice. It is like compounding, correct? 1 plus R to the power n. Either you take third year and apply 1 year growth, or you start from today, then you apply 3 years, 4 years growth. That means series will not have a constant number. It will grow at a constant rate. Now how will you identify whether in the question it is D by K or D1 by KE minus G? Depends on whether growth is given or not. Yes, you have already copied D1 by KE minus G. By the way, for this G should be same. They should say it will grow at 7% forever. If it is 7%, next year 9%, next year 4%, then this formula can't be used. That's a separate discussion. Yes. As the cash flow is starting from end of year 1, the above formula will give you value on year 0. Always valuation is done 1 year before you get the cash flow. Remember, you put FD today, you get interest after 1 year. That means interest will come 1 year later. Value should be done 1 year before. In case, now you tell me, in case the first cash flow itself is coming at the end of year 2, then your formula will give you value at the end of year 1. From there, you'll have to multiply DF to bring it down to today's number. I think with some examples you can understand. Same way, I've already told you, in case cash flow is coming from year 2, it will be D2. But then since it is D2, this D2 by KE minus G will be then multiplied by discounting factor for year 1. Why? D2 is taken, that means value is at the end of year 1. From there you have to bring it down to today, therefore multiply by DF year 1. Looks very simple but enough to confuse. When you're getting cash flow from 7th year, valuation will be 6th year. From 6th you have to come down to 0. Correct? Let's try example 4. Example 4. What would be the present value of cash flow of rupees 120 at the end of year 1, and thereafter growing at a constant rate of 12% per annum? Discount rate is 12%. Now read the data properly. This 120 rupee will come to you at the end of year 1. That means this is already D1, correct? That means what should be the data? Numerator, present value means intrinsic value is equal to D1 by KE minus G. Tell me what happens. D1 is 120 divided by 12 minus 2, 1200. Just in calc you do this. If D1 is 120, how much is D2? 120 plus 2%. What's the number? And D3? And this will continue for how many years? Infinity. This is the meaning of infinite. Remember in 8th standard GP series, 1 plus R, 1 plus R to the power 2, 1 plus R to the power 3, and so on. Infinite GP series is this itself. When you invest and you get some money forever, but that has some growth also, right? But now tell me, in Excel sheet, what should be the change? We wrote 8, 8, 8 forever. But now it won't be 8 forever. It will be 8 plus growth, that plus growth, that plus growth, and so on, correct? The same case, what's going to happen now? Tell me what should be the change. This will become 120. Now I can't copy 120 because this will grow at 2%. Just now you did 122.4 and this will grow. Now don't worry when you see a big number after 250 years. It has to be big. 16,619 rupee dividend you will get after how many years? 250 years. And what is the growth? Sorry, what is the DF by the way? 12%, correct? That means this should be now changed to 1.12. This further divided by 1.12 and this will continue forever. Sorry. Therefore, the value of this is 1200. So even though you are getting 16,619 rupee dividend, after 250 years, it is worth 0. So don't think because there is a growth, cash flow size will be big. Whatever is a big number, you're multiplying with 0. What is a use? Forget 2%. Even if you're growing at 20%, this number will be very big. But then you're multiplying with almost 0 after 250 years. Whatever is the money, it gets multiplied with 0. So it won't make any difference. Clear? If you have free time today, do it for 500 years. Next, example 5. I want you to try this. Consider example 4 and assume that annual cash flow starts from end of year 4. What would be the present value of cash flow stream? Now you tell me your formula numerator cannot be D1. You're going to get the cash flow from D4. When you're writing D4, that means value will be V3. Following? From there you have to bring it down for 3 years. Then you'll multiply by DF3. Give a try. Tell me numerator will be D4 by KE minus G. But since this number will give you value at the end of year 3, this should be multiplied by discounting factor 12%, third year. 120 will come after 4 years. By the way, please don't do 120 plus 2% plus 2. The 120 will only start from year 4. That means 3 years you earn nothing. Understand that way. 0 plus 0 plus 0 plus 120 from their permanent growth at 2%. Divided by 12 minus 2. But this will give you value at the end of year 3. This should be multiplied by discounting factor 12%, third year 0.712, 854. Yes. Why is it less than example 4? Because you're not getting first 3 cash flows, correct? That 120, year 1, year 2, year 3, those 3 things will not happen. That means you buy share today and keep quiet for 3 years, literally no return. So when the return is less, value will also be less, correct? Tell me here what should be the change in my calculation then. Quickly, this will be 0. Hello. Yeah, sorry. Tell me what's the change. 0, 0, 0, and this number is 120, and from here it's 2% growth, and discount rate is anyway not, I'm just changing it here, 12%. So first 3 years you are nothing, and then you start earning 120, and from there constant growth forever, and this number comes to 854.14. Done. Let's continue. Example 6. Find out present value of following cash flow stream with discount rate 10%. At the end of year 1, 30 rupee. End of year 2, 40. End of year 3, 45. Thereafter, it will grow at 3% per annum forever. Again, my question, D by KE minus G cannot be used from beginning, correct? That can be done only from the point of start of the series of infinite cash flow growing at same rate. That means I have to prepare a table. Year 1, 2, 3. Now you know why it is 1 more 3, because from year 4 the series will start, correct? 30 rupee, 40 rupee, 45 rupee. Now tell me, when I'm standing at the end of year 3, what I am seeing in future is infinite cash flow with constant growth. That means now I can use this formula. But here remember, you cannot take 45 because 45 is D3. When you're standing at the end of year 3, you will count year 4 as D1, correct? Think. When you're standing at the end of year 3, you will see year 4 dividend, and year 4 dividend is not 45. Year 4 will be 45 plus 3% growth. That means numerator will be D4 actually. 45 into 1.03, or in calci 45 plus 3% divided by 10 minus 3, 662.14, 0.909, 826, same 0.751. Now when you multiply, 591 or 592 is the intrinsic value. Done. Can I? Yes. Example 7. This is interesting. What would be the present value of cash flow if you are getting 120 rupee at year 0 and thereafter growing at constant rate of 2% forever? Discount rate is 12%. First of all, standing today, how is my future looking? Is it constant dividend or dividend with growth? Dividend with growth. That means I won't be earning 120 at the end of year 1. D1 itself is 120 plus 2%. Correct? That means can I use D1 by KE minus G? Yes. But that won't be final answer because that will only be counting from D1. Actually, there is D0 also here. Able to follow? Tell me, on D0 should I apply any discounting factor? Why no? Because today 1 rupee is 1 rupee. That means my answer will start from 120 plus something else. And that something else is D1 by KE minus G. Able to follow? One more confusing part. When you do D1 by KE minus G, you get one number. Is that value as on today or value after 1 year? When you do D1 by KE minus G, the value that you get is the value as on today or value after 1 year? Value as on today, because value is always 1 year before starting of infinite series, correct? So when you apply D1, you get value on today. When you do D4, you get value on year 3. From year 3, we went down to year 0. But here, infinite series is starting from D1. That means value will already be as on today. Correct? That means you have to start with first 120 plus. Why 120? This money is coming right now. It's like joining bonus. You don't have to count it as month end salary, correct? It is that day's money plus D1 by KE minus G. D1 will not be 120. It is 120 plus 2% divided by 12 minus 2. No need of applying any discounting because D1 by KE minus G is already value as on today. Yes. Listen. That means a slight change in my Excel sheet now. Tell me, I think I'll have to add one more row now. Correct? This is 0 and you're earning 120. This 1 rupee is anyway 1 rupee. So this will be 120 into this, and now this will be 120 into what is the growth rate? 1.02. Correct? And this will continue forever. And then what is the discount rate? DF 12 or 10? 12%. That means this is 1 divided by 1.12. Already done. 1, 2, and so on. This is 1, 2, 2, 4. This is D. First one is not multiplied in the formula. Series will start from this line 1, 3, 4, 4. Actually, this plus infinite series. Done. Now come to class work question number 1. Yes, read. A prospective investor is evaluating the share of a company. He is considering three possibilities. First scenario, the company will maintain to pay its current dividend per share without any increase or decrease. This is constant dividend forever. Second, another possibility is that the dividend will grow at an annual rate of 6% perpetuity. Perpetuity means forever, forever means infinite series. Third, the third scenario is that the dividend will grow at 12% per year for first 3 years, and then it will grow at 7% for next 3 years, and then it will grow at constant rate of 4% forever. That means you can still use d by ke minus g, but then that can be used only once you know that the growth rate is constant forever. That means you can't use it from year 1. Able to follow? I'm talking about third scenario. In third scenario, dividend will grow at some rate in first 3 years, some other rate in next 3 years, and then one rate forever. That means that forever will happen, but not from the starting. Correct? That means d by k minus g can be used, but not from the very beginning. Now, last year dividend per share is 3 rupee. Be careful. Last year dividend is paid today. That means this number is d0. Last year dividend is not paid in last year. Last year dividend is paid today. This is D0. And current market price per share is 75 rupee. Current market price is P0, today's market price. If the investor's required rate of return is 10%, this is applicable rate, discounting rate to him. Calculate the value per share under all three circumstances. Should the share be purchased or not? Now this decision is based on whether value is more or price is more. If value is 35 and share is traded at 75, then you think it is overpriced, you won't buy. If value according to is 85, it is traded at 75, it is underpriced, you will buy. So that is the final decision once you find out the value. Start. Solution for equity share valuation, ESV, question number 1. Small class note, if you want to write, you write, otherwise you can directly start from first scenario. Last year dividend means D0 because last year dividend is paid today. Go to the question. In first scenario, what is expected to happen? D will remain same. That means I can straight away use D by K. Value of the share is equal to D by KE. Now you don't have to worry whether I should write D0 or D1 or D2. Anyway, the D is same. This will be 3 rupee by 0.1, 30 rupee. Correct. Tell me, what is the market price of this share? 75 rupee. And according to you, it is worth only 30 rupee. That means it is overpriced. It should not be purchased right now, as the MPS is more than our calculated price. For this, our calculated price in bracket, you write intrinsic value. As the MPS is more than intrinsic value, the share should not be purchased. This is case A. Go back to the question. Second case, they said another possibility is that the dividend will grow at an annual 6% forever. That means this is D1 by KE minus G. Start. Second scenario, value of the share is equal to, write the formula first. Value of the share is equal to, remember series will start from D1. So it is D1 by KE minus G. Tell me, will I take 3 rupee as D1? No, that is D0. So D1 how to do? 3 plus what rate of growth? 6%. Or in writing, you can write it as 3 into 1 plus 0.06. Correct? But in calc it is 3 plus 6% to be divided by what is the applicable rate? 10% minus growth is 6%. There can be one doubt here. I'll discuss after the solution. It's more of maths doubt than FM doubt. Can growth rate be more than 10%? Then denominator will be minus. Then what to do? I'll discuss separately. Let's not deviate now. What's the answer? 79.5. What's the ongoing price? 75. That means market price is less than intrinsic value. The share should be purchased. Correct? Third scenario is interesting. On screen, please. I've just cut that part. The third scenario, dividend will grow at 12% per year for first 3 years. In calci start, how much is D0? 3 rupee. How much is D1? 3 plus 12%. D2 how to do? Plus 12%. Keep doing. One more. D3 plus 12%. What's the number now? But continue. Question says it will then grow at a medium rate of 7% for next 3 years. That means now onwards you have to in calci do plus 7%. Once again plus 7%. Once again 7%. Done. Now tell me you have reached what now? D6. Hello. You have reached D6 and then it says it will grow at a constant rate of 4% forever. That means you will do plus 4%. That will be D7. From there you won't do because from there infinite series. That means you can use d1 by ke minus g formula, but you can't use it at the beginning. So for first 6 line items, you will have to do a table. After that, since the infinite series will start from d7, you will get the value at the end of year 6 and then multiply by df and other things can be done. So can the formula be used? Yes. But can it be used right now? No. Because infinite series is not starting from D1, it is starting from D7. Able to follow? So table is not needed every time. Table is needed when this happens, when formula can be used but can't be used from beginning. Start. Third scenario, value of the share, a small table. Year, cash flow, DF, present value is cash flow into DF, or as I call it, DCF, discounted cash flow. 1, 2, 3, 4, 5, 6. After that, it's an infinite series, so I won't write 7, I will write only 6. Please understand, infinite series starting from 7th year, so value will be end of 6th year. Tell me, first year, I think you did this in calci. 3 plus 12% was 3.36. But while writing, you have to show this way, 3 into 1.12. Then comes 3.36 into 1.12. Or another style is 3 into 1.12 to the power 2. Correct? Grow twice. Then 3.76 into 1.12, 4.21. Next 4.21, but now growth is only 7%. So it is into 1.07. That will be for D5 also, D6 also. Now understand this, a common confusion. Why did I write year 6 once again? Because if I am standing at the end of year 6, what I see from their future is same rate forever. That means that infinite series will start from D7. Therefore, I can find the value at the end of year 6. Tell me what to write. Should I take 5.16 now? No. 5.16 is D6. Standing at the end of 6th year, you have to take 7th year, correct? Guys, always understand this. If you want IV0, you are taking D1. That means if you want IV6, you have to take D7, correct? And D7 is not 5.16. It is plus 4%. 5.16 plus 4%. This is basically D7 by KE minus G. D7 by KE minus G will give you value at the end of year 6. And this has to be multiplied by 6th year DF. Anyway, we have done a table. So it will be 0.909, 0.826, 751, 683. But remember, last 6th year is same, 564, 564. This when you multiply first year 3.05, 3.11 and so on. Those who have done, answer is around 68.7. No, 68.74. Some minor rounding off difference. Correct. Why are we not considering year? Sorry, I did not get. Sir, these are three different scenarios. These are three separate questions. And okay, why are we not considering year 0? Today, if I buy share, will I get D0? No, no. Because in that case, it was printed. I told you it's like joining bonus. Not everyone gets joining bonus. Correct? Listen, simple. If I say you join my company today, salary is paid at the end of year 1, then you won't count anything here. You'll do D1 and so on. If I say you join today, you'll get joining bonus plus salary starting from end of year 1. That question was joining bonus plus salary starting at the end of year. But no company will tell you buy share today, I'll give you dividend today. So that joining bonus is applicable in the job example, not in share example, right? If you keep FD today, they won't say take interest today. Yeah. So year 0, most of the cases, it's only outflow. There is no inflow. You won't get anything in year 0. All okay? Now tell me, value of this share is 68.74. What's the market price? 75. Write down as the MPS is more than the calculated price. The share should not be purchased. The share should not be purchased. Practical mission. How will we know the growth rate? I'll come to that. Listen. One doubt about which I wanted to talk. Second is the doubt that he has asked. First, I'll discuss his doubts. Sir, in real life, how will I get to know at what rate dividend is going to grow? Tell me, if I'm buying a share today, say TCS share, how do I predict future growth rate? One is the past data. Second, every time they release quarterly results, there is also something called management commentary. And if you attend AGM or watch any AGM speech, in that director speaks about all this expected growth, right? And there is a formula to find out G. Maybe we'll go there tomorrow. G is B into R. B is reserves into R is rate of return on investment. But as of now, G is given in the question. So if you ask me, how much do you think will be growth in your income? How will I answer? It's based on my past understanding. Able to follow. Anybody you ask how much is going to be the growth of your income next year, how will they answer? One, they have past data. Second, they know something in at present that in future things may change. So growth rate is predicted. More than growth, how do we even know that 3 will be 3? Company may be in loss. Company may give you less than 3, company may give you more than 3. All of this is estimation. Any valuation you do, it is purely based on estimation. Why are you buying that site in Jainagar? Because you think in future price will go up. How do you know in future it will grow up? In the past it has grown. Understand, if you just minus this one logic, then you cannot do any analysis in stock market. Entire technical analysis, the chart, they say this is all time high, this is all time low, this is support level, this is resistance level. No, what is resistance level? It hits that number and then it comes down. Again it hits that and comes down. 2-3 times if that happens, then those who follow stock market, they call it as resistance. Once it reaches there, people are not buying after that. And then same way there is something called support level. Once it comes to that, people are buying. Then again it goes up, again it falls. No one is letting it to go down below that number. Suppose the resistance is 785, support is 765. That means the moment it reaches 765, all those who believe in technical analysis, they say buy recommendation, buy recommendation. Why? It has reached support level. But what if you buy and then war starts? Then that support level won't work. Entire technical analysis go by this logic. Whatever has happened in the past will happen in future also. Understanding support and resistance is this resistance, beyond that it is not expected to go. So they say it has reached the resistance level. If you're already holding, better you sell, because it has never crossed. But that doesn't mean it will never cross. Correct? Then if that's the case, one time it reaches all time high, it will never cross all time high, because that becomes a resistance level. So all these numbers are based on an estimation. We believe it will grow at 5% based on 2 factors. In the past it has grown, and present management is saying that they are expecting same growth to continue. Done. One. Second, as I told you, a mathematical worry. I can do this formula d1 by ke minus g. Yeah, here 0.1, and this is just 6%. Correct? What if this is 16%? Then this will be 0.1 minus 0.16. Correct? And then denominator is a negative number. Then you can't do any valuation. If you do, you'll get negative share price, which is logically incorrect. This will never happen even in reality, not for formula sake. If your expected rate of return is 10%, and if company is growing at 16%, whatever is the price you buy, why do you want to know its value? Think. It will never grow at a rate higher than your expected rate. If that is happening, you don't need valuation. Whatever is the price, buy. Simple. You want 10% return. It is growing at 16%. Buy now, whatever is the rate. What's the problem? Number one. Number two, in reality, no company will grow beyond the expectation of shareholders, because the expectation of shareholders is so high that company cannot grow above that level. Therefore, if company is growing at 6%, tell me how will people expect 7%? That means it is always 7 minus 6. You will never be like this. Company is growing at 6%. Next year I want only 5% growth. If it is already growing at 6, you expect 7. So your expected rate, even in real world, will always be more than growth rate. And understand, growth rate, even if it's a small number, in long run, when you see that growth rate, it's actually a huge big number. You saw 8 rupee when growing at even 10%. After some year, it reached 17,000 rupee. Understanding? So country growing at 3%, don't think 3% is a small number. 3% compounded, next year 3% on 103, and so on. So even 3-4% growth is a very very big thing. So mathematically a negative number will not help you do valuation. Real world, if growth is higher than expected rate, you don't need any valuation, simply buy at whatever rate you buy. Following? Yes. Third scenario, yeah, it is growing at 12%, correct? Correct. Correct. When you are thinking of infinite growth series, you should not restrict to 3 years. Suppose you are planning to buy the share and keep it only for 3 years. Then you just need column 1, sorry, row 1, row 2, row 3. But in row 3, you will also have sale price of the share. I think that itself is your next question. Read next question, first line. No, maybe ESV3. Question only starts with this line saying, see ESV3. An investor is looking for a 4-year investment, then he will not use these formulas. These formulas can be used only if you're talking of perpetual growth. Therefore, that question won't come if there is a perpetual growth, whether to do it separately or do it in table form. This table or the formula can be used only if there is infinite series. Yeah. Done. So this doubt will come someday. Just make a note on top of the page. Class note. Top of the page, not applicable for this sum. In these formulas, we are assuming that K is always greater than G. K is always greater than G. So Ke minus G is always positive. Done. The earnings of a company has been growing at 15% over the past several years and is expected to increase at this rate for next 7 years and thereafter, underline, at 9% in perpetuity. Perpetuity is forever. That means this is the question of infinite cash flow series. That's the first condition because it is forever. Second, it is a question with growth. But for us to use the formula, growth rate should be single and forever. It should be same growth forever. That is happening, but not from the beginning. First 7 years, growth rate is different, and later, forever, growth rate is different. That means this formula can be used, but cannot be used immediately. Correct? Yesterday we have discussed this. If starting from the beginning of the series itself you have single growth rate, then you can use the formula at the beginning itself. But if there is different growth rate, then we may have to do a small table and then this formula can be of some use. Continue. It is currently earning 4 rupee per share and paying only 2 rupee per share as dividend. Our formula is not E1, our formula is D1. That means it will not be based on earning at the end of year 1. It is dividend at the end of year 1. Listen, I think yesterday some of them had this question and this I had explained in day 0 class also. All the valuations that you do are based on cash outflow versus cash inflow. Why should not we do valuation on earning basis and why are we doing it on dividend basis? If I am buying a share, cash is going out from my pocket. I want to know at the end of year 1 how much is coming to my pocket and not how much company is earning. I know earning is a broader concept than dividend. They may earn 7, pay you only 1. For your formula, you will use only 1. You won't use 6 at all. But that 6 is anyway reinvested. And when you reinvest, the company will anyway grow. and that will reflect next year. Again, you will earn more, you will be in a position to pay more dividend. Or if you don't pay dividend, you keep it as reserve, you reinvest, you make profit, share price will go up. So either in the form of dividend or in the form of share appreciation, the investor will finally get the benefit. Not only this, all valuations that you do are based on cash flow and not based on earnings. Therefore, if they give earning and dividend both, you should use dividend and not earning. Suppose if they give only EPS in the question, then we can assume that payout ratio is 100% and take that itself as dividend and then work out the solution. If company is earning 7 rupee and paying you nothing, then where is present value of future cash inflow? Future cash inflow is zero. Imagine you buy a share today. 7 years, company is earning 7 rupee EPS, paying you 0 rupee. Now how to do present value of future cash inflow? There is no future cash inflow for 7 years. Correct? That means it is 0, 0, 0, 0, 0. Now if they are earning so much and keeping everything as reserve, that reserve is naturally understood that it is reinvested, and if you are reinvesting, then company will grow. And if company grows for 7 years, then 7th year later price will be super high, not just high, super high. That means at the end of 7th year you will have a big cash inflow. So either cash inflow in the form of dividend or cash inflow because of the appreciation when you sell. Therefore no formula is based on earning per share, it's always on dividend per share. But there is a formula which considers even earning, but then commonly used is always dividend. The other day I showed you some valuation reports, and there also it is based on free cash flow. It is not based on profit after tax or profit before tax. And now profit after tax, you add back depreciation and other things so that you get the correct cash coming to the business. So it is always on cash. If I am an investor in a share, what is cash inflow to me? Dividend, not EPS. Yes, there are formulas where earning is used for academic purpose. Earning approach, what we are doing is dividend approach. Dividend is called cash flow approach, and since we are discounting, it is also called dividend discount model. Yeah, with growth, without growth, two variety. But remember this always, if you have EPS, you have DPS, you will always go by DPS, because if I'm buying a share, there is cash going out, then what I want to know is how much is the cash coming in. Therefore don't start with 4 rupee, you have to start the calculation based on 2 rupees. Continue. What should be the present value of the share? That means today's value 0 with discount rate of 12% for first 7 years and 10% thereafter. Now compared to previous session discussion, here the discount rate is also changing. Yesterday what we did, only growth rate was changing. Now even the discount rate is changing. For first 7 years you have one number, and after 7 years you have another number. No need to worry, you only have to make one small change, that too only after 7th year. First 7 years there is no problem anyway. First write an important class note. ESV2 class note. From an investor's perspective, from an investor's perspective, since there is cash outflow, since there is cash outflow on purchase of a share, since there is a cash outflow on purchase of a share, he will compare that with cash inflow at the end of year 1, 2, 3, 4 and so on. Year 1, 2, 3, 4 and so on. Full stop. It means for all calculation purpose, comma, by default, comma, we take dividend and not earnings. Yes. Now start the main answer. Computation of value of share. Computation of value of share. Heading. Yes, please read the question. What is 4 rupee, by the way? It is currently earning. That means this is E0 EPS, and paying 2 rupee. That means this is D0. But your formula will start from D1. That means it is not 2. What is the growth rate for first 7 years? Expected to increase at 15%. That means it will be 2 into 1.15, or in calci simply 2 plus 15%. Start year 1, year 2, 3, 4, 5. Please read the question carefully. Up to 7 years, one number, and after that forever another number. That means your table will have 1, 2, 3, 4, 5, 6, 7. Once again 7, because from 8th year forever you will have same discount rate. Understand this way. Standing at the end of year 7, what I see is different. Correct? Standing at the end of year 7, you will not see 7th year, you will see 8th year. From there, for infinite years, growth rate is different. So first year, 2 into 1.15, or in calci 2 plus 15%. Next year, this new number 2.3, that into 1.15, or you can even present 2 into 1.15 to the power 2. One second, if you can pause, please. Listen. 1 second. I said 2 into 1.15. How did we reach 1.15? 1 plus r to the power 1, because it is 1 year. Correct? What is the other way of reaching the second year number? 1.15 into 1.15. Growth on growth. Correct? In calci do this. 1.15 into 1.15. What's the number? What is this called as, by the way? Don't multiply with 2.2 rupee. What is this called as? 1.15 into 1.15. Are you discounting or are you compounding? That means this is called future value index factor. When you do 1 divided by 1.1, 0.909826751 is called present value index factor, because you are bringing down the money. When you are doing compounding, it is 1 plus r to the power n to the power 2, 3, 4, 5. When you do, you are calculating future value index factors. That means it can be even presented like this: 2 into 1.15 to the power 2, again 2 into 1.15 to the power 3, or in some question they will only print future value index factors, the one that you calculated. Then you can take the base number and multiply with that. Understanding? For compounding, you need future value index factor. For discounting, you need present value index factor. In raw sentence, future value index factor is into 1.15 into 1.15 into 1.15. In present value index factor, you divide it. 1 divided by 1.15, divide by this, divide by this, divide. It's factor into factor. Therefore, it will be factor by factor when you want to discount. Done. In some questions, they will print future value index factors. Then also, students do plus, plus, plus that many times. You can directly multiply from the data. Yes. Next, give a try in that style. 1.15 into 1.15 into 1.15. This should be third year future value index factor, also called as compounding factor. When you're multiplying, you're compounding. That into base number is 2. That will give you same 3.05. Continue. This will continue for 7 years. I think we have come to 5.35. Listen now. Till this is okay. Now we are standing at the end of year 7. From here, tell me what should be done. You have what growth rate from here? Forever. Correct. That means from here you can use D1 by KE minus G. And when you're standing at the end of year 7, D1 means D8. When you're standing at the end of year 7, D1 means D8. Understand yesterday formula IV0 is equal to D1. Today you are standing, so you took next year dividend. Now when you're standing at the end of 7th year, you should be taking 8th year dividend. 8th year dividend, how to do? 5.35 into what is the growth rate? 9%, 1.09, or in Calci 5.35 plus 9%, to be divided by Ke minus G, because from here forever the series begins. But here what should be considered as Ke? As per the question, discount rate will change. Discount rate will change. That means for this relevant discount rate is 0.10 minus 0.09 Ke minus G. If this was not given, we would have taken same 12% all the time. Correct? So 0.10 minus 0.09, that comes to 583.15. Yesterday we have discussed this. The formula d1 by ke minus g can be used from the point when infinite series begins. Now infinite series will start from year 8. That means you'll get the value at the end of year 7. Value is always 1 year before the beginning of infinite series. Now discounting factor is 12%. Expected rate of return. Here even the last line will be same 0.452, because at the end of 7th year it was 12% only. Correct? Last two lines both are year 7, that's not year 8. And then when you multiply, you get present values. Sorry, last row, huh? Won't it be? Huh? For first 7 years it is 12%. From 8th year it is 10%. Correct? Therefore, when I'm standing at the end of year 7, my 8th year dividend when I'm taking, it should be 10%. But then by applying that formula, you'll get the value at the end of 7th year. For 7th year anyway, factor is 12 only. Observe everyone, last line item. First of all, can somebody tell me why did I take 0.10? Last row I'm asking, why did I take 0.10? Standing at the end of year 7, infinite series is starting from 8th year, and for 8th year applicable rate is 10%. Correct? With that I got the value. Tell me, if infinite series is starting from 8th year, value will come at the end of 7th year. For 7th year, multiplication should be discounting factor at 12 only, no, not 10. Understanding? I have given a class note for this. Don't worry, after this we'll copy that. If anyone has completed, is it 279, 280, 278, is it? For your reference, write class note. Understand, 583.15 is the value at the end of year 7, which is based on cash flow of year 8 and onwards. Correct? In this period, appropriate discount rate is 10%. Which period? 8th year and onwards. 8th year and onwards, discount rate is not 12, it should be 10. And growth is given as 9%. Therefore, formula will be based on 10 minus 9. But by using this formula, you will get the value at the end of 7th year. That can be anyway multiplied by discounting factor at 12%. Clear? Copy. Tell me, if I put this in Excel sheet, what should happen? Line item 1, 2, 3, 4, 5, 6, 7, 2.3, 2.65, 3.05, 3.51, 4.04, 4.65, 5.35. After that, for total 250 years, as we did in last class, that will grow at what percent? 9%. It will be into 1.09, 1.09, and so on, drag till 250. What will happen in DF column? Year 1 will be 1 divided by 1.12, then divide by 1.12. This I'll divide by 1.12 up to 7th year. 8th year I will divide by 1.1, because from 8th year DF is changing. It will become 10%. From there it will be divided by 1.1 for the 250 year series. And then do the last column total, you will get same 279.2. Done. So discount rate is changing from year 8, not year 7. Yes. Before this, I want you to try one practice problem, page 96. Page 96. Practice problem ESV 12. Yes. An investor, just a second. An investor is considering to purchase the equity share of LX Limited, whose underline current market price is 112. This is ongoing price. Next, you have it on screen. The company is proposing a dividend of 4 rupee next year. Underline proposing a dividend next year. That means it is D1. Correct? Yesterday I told you, you have to observe the wordings. If they say current dividend, present dividend, then it is D0. When they say proposed next year, directly it is D1. This will grow at 20% per annum for year 2, year 3, year 4. In Calci, year 1 is 4 rupee. Tell me, year 2 will be 4 plus 20%. This will be once again plus 20%, once again plus 20%. Easy to understand? After this, now listen, you will only solve this. First understand this. The growth will decline, underline linearly to 16% after year 4. What does it mean? This 20 will not come down to 16. It will come down to first 19%, next year 18%, next year 17%, and then 16, and thereafter, read next line, it will stabilize at 16% infinitely. That means my growth calculation is like this. It will start from 4 rupee and then plus 20%, plus 20%, plus 20%. After that, plus 19%, then plus 18%, plus 17%, then plus 16%, from there forever 16%. That means this formula D1 by KE minus G you can use only after growth is stabilized. This cannot be used if growth is changing. That means you have to do in the same way we did classwork sum one, sum now D1, D2, D3 you have to do. Once it becomes 16 and forever, you can put the formula D1 by KE minus G. Able to follow? This is the way to do if the word is decline linearly. Linear is 1, 1, 1 every year. Next, the investor requires a rate of return of 20%. This becomes the discounting rate or KE. Next, you are required to calculate the intrinsic value of the share, whether it is worth to purchase the share at this price or not. For that, we have to compare this with the market price and then decide. Yes, I'll wait. Give a try. First, working note 1. Calculate dividend for all the years. D1 is equal to 4 rupee. D2 is equal to 4 into 1.2. Correct? 20% growth. D3 new number, I think 4.8 into 1.2. 4.8 into 1.2. After that, you get what? 5.76. Correct? On that, one more 20% growth into 1.2. That means we have reached till D4. After this, growth will decline linearly. That means you have to take 19% next year, 18 next year, 1.19, 1.18, 1.17, and then 1.16. Where are we now? I think D7 in the working. Yes. Now the main table. You have the numbers on screen. Is this matching now? 4 rupee, 4.8, 5.76, 6.91, 8.22, 9.7, 11.35. After that, if you have done one more number, no problem. That will be D8. But anyway, remember, from 8th year forever, it is constant. Yes. Now the main table. Calculation of intrinsic value. Year 1, 2, 3, 4, 5, 6, 7 you write. But remember, 8th year onwards, infinite series with same growth will begin. That means last line in your answer will be 7th year once again. Correct? Infinite series First cash flow is from 8th year. This will be 4, 4.8, 5.76, 6.91, 8.22, 9.7, and 11.35. In the same year 7, tell me, year 8 will be, how much is the dividend? I think some of you have done this in working note already. 11.35 into 1.16. How much is that? 13.17. Tell me now, if you're standing at the end of year 7, this is D8, correct? If you want IV0, you take D1. That means if you want IV7, you take D8. So D8 divided by KE minus G. KE is 20%. Growth rate from there forever is 16%. Now no confusion which growth rate to take. Forever it is 16. That means it is 0.2 minus 0.16. That will be 0.04. 329.15. Always remember this first year of infinite series. Correct. This will be multiplied by discounting factor. Last row also is 7th year DF only, not 8th year. This will give you approximately 114.9 or 88. That is the intrinsic value. Done. They've also asked you whether it's a good stock to buy. What is the ongoing market price? 112, and that is less than the intrinsic value. So it is a good stock to buy. One line after the table. Since market price 112 is less than intrinsic value 114.88, comma, the share is worth buying. The share is worth buying. Done. When will this happen? There will be growth but at declining rate. That is what happened here. 20, 19, 18, 17. You are still growing but at a slower pace. In all the real estate rentals, as the building becomes old and old and old, you will get rentals but you won't be able to increase it in the same rate you increased it in the initial stage. Understand? First year, second year, third year, to tenant you can say extra 20% rent next time, but after 15 years of that building you can say extra, but you can't say 20% extra because they're not ready to, they're not willing to pay. This may not happen in shares, that it will grow but at a slow pace, but in reality in most of these kind of assets, depreciating asset, basically you can charge more but the increase cannot be at the same rate. This is one side. The other side, there is also something called product life cycle. After a point, though there is a growth, it will grow at a decreasing trend. Your company will grow but not at the same speed at which it was growing in the growth phase. It is introduction, growth, maturity, and then you start declining. In that maturity phase you will grow but not at the way you were growing in the second phase. Introduction is very slow growth or no growth. After that is the big jump, and then it will grow but at a downward trend. After that, the downward trend completely begins. 16 will come to 15, 12, and finally someday 0, you close the company, right? Therefore, this is true even from life cycle, product life cycle angle. Unless you change the pattern, unless you change to the customs and uh, demands and tastes of the customers, you will grow, but at a slower rate. Correct. Now, currently electric vehicle segment is not in this phase. They are growing at a faster rate. Growing at a faster rate. Last year 18% growth. This year will be more than 18. Growing at a increasing rate. But this may not be true for non-electric. They are growing, but at a lower rate. It's a decreasing trend. Still there is a growth. It was 20% growth. Now it is 19% growth. 17, 16. They are growing, but at a decreasing trend. So whenever an alternate product comes into market, you will still grow, because not everybody will shift to alternate product, but growth will slow down. Understanding? Yes. Coming back. Question number 3. Yes. An investor is looking for a underline 4-year investment, which means I cannot use d by k or d1 by ke minus g. That is possible only if the cash flow series is forever. The perpetuity is the condition. Here there is no perpetuity. That means you have to do table d1, d2, d3, d4. And if you're keeping the share only for 4 years, at the end of 4th year you may be planning to sell it. That means it will be d4 plus p4. D4 plus P4, you will receive the dividend and sell the share. Now no need of formula, it is simply present value table. Just read. The share of a company is selling at 75 rupee right now. This is P0 today. They have plans to pay a dividend of 7.5 per share each at the end of first and second year. That means D1 and D2, 7.5, 7.5. And 9 and 15 respectively at the end of third and fourth year. Simple table, 7.5, 7.5, 9, 15. If the investor's capitalization rate, investor's rate means cost of equity, which is your discount rate, is 12%, and share price at the end of fourth year is 70 rupee. This is what now? P4. Price at the end of year 4 is expected to be 70 rupee. What is the value of the share? First line of this topic yesterday, value of anything is present value of future cash inflows. Now there are 4 future cash inflows: dividend 1, dividend 2, dividend 3, dividend 4. But there is one more. At the end of 4th year, you are selling. When you sell, you won't get P0, you'll get P4. And that's also a cash inflow. Correct? That means a simple table. Year 1, 2, 3, 4 cash flows multiply by discounting rate. No need to think growing or not growing. Anyway, 4 years only. It's not perpetuity. Numbers are given. Simple multiplication. Start. ESV3. Year 1, 2, 3, 4. Cash flow will be 7.5. 7.5. 9, 15 plus 70. You will collect dividend and sell the share. Both will result in cash inflow. Since money is coming in future, it is discounted so that we get the present value. 0.892, 0.797, 0.711, 0.635. Present value is cash flow into discounting factors. Rounded off to 73.0. 8 or 73 rupees. Question last line says, would it be a desirable investment? What is the ongoing market price? 75 and its value is 73. That means it's not a preferred investment. One line, since the MPS is more than our calculated price, means intrinsic value, the price should not be purchased. Share price at the end of year 4 is 70, correct? But you are buying today, no sir. You have to buy today, you will sell at the end of year 4. So your investment is not 70, your investment is there in second line. The share is selling for 75 right now. If you buy at the end of year 4, how will you get D1, D2, D3? Correct. Now I'm making one small change in this question. Write down in the notebook, classwork. In the above question, in notebook you write directly. In the above question, if expected dividend is 7.5 rupee per annum for 4 years and all other things remaining same, full stop, calculate intrinsic value. If you go fast, you will do a silly mistake. Intrinsic value, anyone? 67.26. Rounding off is okay. That's okay. 67.26. Any other answer? I'm sure there'll at least be one or two more answers. Same. 67.26 is one answer. Anything else? No? Same answer. Same. Listen. What's your working, by the way? Solution, what did you do? Year? 1, 2, 3, 4. No. Can we use D by K? Can I use D by K? No. D by K is if you are holding it forever. In the question, it is only for 4 years. That means D by K is not usable at all. That is perpetuity. But here, if you have noticed, this number is same every year. And if the number is same every year, we don't, and it is for limited period, we call it as what? Annuity. For annuity, you don't need a table actually. You might have got the correct answer, but there is no need of doing this table. What to do? 7.5 into discounting factor year 1, year 2, year 3, year 4. That means I can simply do 7.5 into summation of discounting factors. But last year, I said all other conditions remaining same. That price you have to multiply by discounting factor 4th year. That means value of the share today, year 0, is equal to 7.5 into PVAF at what rate? 12% for 4 years, correct? Plus 4th year, what's the number? 70 rupee, but this will be discounting factor into 12% 4th year. Some books even write it as PVIF. present value, interest factor, or index factor. The moment you see A, understand they're doing summation of discounting factors. Now this will be, anyone, if you have done 7.5 into what's the summation factor? 3.037 plus this 70 rupee 0.635. This is the final answer. Okay, some have this confusion. Sir, year 1, 2, 3 is constant inflow. Fourth year it's not 7.5, it is 7.5 plus 70. If you go by that, then you can show it in this way. You take 7.5 into present value annuity factor at 12% for how many years? 3 years only. Fourth year, you will take 7.5 plus 70. This you multiply by discounting factor 12%. Fourth year. Because 3 years same number, fourth year different number. Then you do 3 years annuity, fourth year separately. Even in that 77.5, 7.5 is same. Therefore, we can actually do 4-year annuity plus 1 year separately. It's like annual cash inflow being same number. Fifth year you have scrap value from the asset when you do NPV calculation. Either you do 5 years annuity and add scrap value separately, or 4 years annuity, fifth year you take separately. Number will anyway be same. So final answer is 67.26. Any one style you can copy. Value 67.26. Tell me, this is more suitable when your annual cash inflows are same, like bonds, interest is same every year, and then you have a redeemable value, which is also noun, par, premium, discount given in the question. So I buy a bond today 100 rupee, they pay me 8 rupee, 8 rupee, 8 rupee, 8 rupee, and then it will be redeemed at 2 rupee premium. That means 8, 8, 8, 8 plus 102. Assume 100 rupee bond par value. So any investment with limited year will not be based on D by K or D1 by KE minus G. It will be based on cash flow into discounting factor. Yes? Doubt? Suppose in this question sale price at the end of year 4 is not given. Then shall we assume that it is sold at the price at which we are buying today? That may not be correct, logically speaking. They should give. Otherwise, people will assume you will keep the share forever. Then it becomes a perpetuity problem. They should give. If the investment is for limited period, they should give you what will happen at the end of the period. If I say I'll buy a commercial property, rent out for 5 years, fifth year I want to sell, then rental income year 1, year 2, 3, 4, 5, fifth year sale value has to be there. If you don't give, then I'll assume that I'll rent out for 6th year also, 7th also, forever. I can't assume today's price will be the price after 5 years, correct? There'll be either appreciation or depreciation in the price over a period of 4 to 5 years. They should give, they will give. Otherwise, you assume it as perpetual investment forever. Yeah. Done. This is more suitable when you have limited period plan. I'll buy now, wait for 2 years, sell it. That means I have only two things: year 1 dividend, year 2 dividend. In year 2, I will be selling also. Yes. Now tell me, all of this calculation, yesterday's and today's class, from where do we get this 7.5, 9, 15? Is it so easy to estimate? All our calculation is based on these numbers, cash flows. And yesterday he was asking, how will you get to know at what rate it will grow? How will you get to know how much they'll give us dividend? Yesterday also I said the same thing. This is based on the past trend and the available data. Nobody in reality will be able to predict how much will be dividend at the end of year 1. You can only go by past data and what management is saying right now, presently. So on any company, on moneycontrol.com, any company name you type, if you scroll down, it will show you dividend trend of last 5 years, dividend trend of last 10 years. Yeah, that you can take the average, that can be assumed as dividend every year. And if you see growth there, then you can assume that even in future it will grow. Again, there are a lot of conditions here. In the past it has grown, doesn't mean in future it has to grow. Therefore, past data is one point, and then you check the current management's direction as to what they are saying. Will company continue to grow at this rate or not? And don't be under this wrong impression, sir. Which director will say we will grow at low rate next year? Everybody will say big only. That's not true. In reality, people are sensible. If you keep saying we will grow at higher rate, next year AGM shareholders will ask you this question. They'll show you last year ka video, and you said we will grow at 27%, but we aren't even growing at 8 9%. That means if you know, being a director, you will have a better understanding of what can happen than being a shareholder. So they will never give you an unreasonable estimate of future. If they do, it's a problem to them. Based on that word, somebody will buy the share, that it will grow at 22%, 25%. Easy to say. 2 3 years you do that. After that, no one will listen to you. Then share price will start going down. Number one. Number two, tell me 1 year later, when actual growth is only 6%, and last year you said you're expecting 22% growth, and you actually come out with result which shows only 6% growth, that year you'll see in the stock market the price of your share. The only way shareholder can show his anger is by selling at whatever available price is, and nobody will buy because they know this director only speaks double digit and achieves single digit. They will never buy. Therefore, don't think in the question they will always give biggest possible growth rate. So are we doing overvaluation? Nobody will commit to a higher growth rate. In fact, even if you say 7% and you achieve 6.8%, share price will drop. Therefore, directors are extremely careful about giving this number because they know what's going to happen in the coming year, right? That too, if you are in a business which has seasonal ups and downs, which is cyclical in nature, 2 3 years it will grow and then trend will change. For 1 or 2 years, you will not grow. Again, you will grow, cycle, the trend will change. If this is the kind of business you are in, or you are into a business which is dependent on climate and other things, then you will never be in a position to give a good growth estimation. Think of today. We are in October 2024, and you have bought shares of some fertilizers, agriculture related equipment company. Now, that director, if he is saying our company will grow, he should first understand weather forecast. Then only he can say whether his company products will be sold at high quantity or not. If monsoon doesn't go as per estimation, sales will not grow as per estimation. In such case, they will never give a high growth projection. They will give slightly lower. That too, if you are in an uncertain business, it's very difficult to give any growth projection. Yeah. Anyone knows any company which is into agriculture and agro related sector? Tractors, tiller makers, fertilizers, chemicals, seeds. Huh. Tell me any company that you know. FACT. Okay. What's the spelling? BEJO. Seeds company. Hmm. Any other agro industries? HMA. Okay. Any of these companies, they won't be able, they will not be in a position to give you projections. This year monsoon was good doesn't mean next year monsoon will be good. And if monsoon is not good, agri activity will be lower. If that is lower, your sales will be lower. Therefore, don't think this growth rate is always double digit, any big random number. They'll be very careful before giving this number. Yes.